Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, August 24th, 5:36 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the Disappointment Edition. State of the market, we're in a mild correction, 5% off of the recent highs in the S&P 500. Checking the trend gauge over here. Last night we put a couple of yellow arrows on market leadership and short term as the NASDAQ 100 closed above the 21-day moving average. Those yellow arrows are gone, along with any hopes that the great earnings report from NVDA might spark the market into a big rally, as we saw a massive negative reversal off of a stellar earnings report. Bottom line is that leaders continue to be under pressure, bearish slash downtrend, whatever you want to call them, not making progress. Short term, all five of the major indexes are back below the 21-day moving average. Medium term, they're all below the 50-day moving average too, as we had failures on the S&P and the NASDAQ at these key moving averages today. Silver lining, all five of the major indexes are still above their long-term 200-day moving average. The market does not get into serious trouble unless the S&P 500 breaks below this level. So what happened today? Last night, after the close, massive beat and raise by NVIDIA on their earnings report, gapped up on the report, continued higher after hours, opened up not as high as it was. It reached 520 overnight, opened up around the 500 level, but put in the highs immediately along with the indexes. Negative reversal right out of the gate. So the gap up on NVIDIA earnings, which was pretty euphoric, turned into an epic fail. Huge negative reversal to red across the board, taking AI stocks down with it, and all seven of the big seven were red. And when they're going to be red, that's going to carry over to the S&P and the NASDAQ, and usually over to leaders, and that's what happened today also. So bottom line, red numbers on the day are 8 growth ETF composite, the RG8, down 1.73%. S&P 500 gapped up 0.4. Huge reversal, closed down 1.35%. NASDAQ 100 gapped up 0.8%. Even bigger negative reversal, down 2.14. Dow down 1.1. Mid caps down 1%. Russell 2000 down 1.3. Global diversified 60/40 stock and bond down 0.81%. Mostly stocks. Bond prices were lower, so yields spiked a bit, but not as bad as stocks were down today. In-house GROTECTION down 0.91%. We'll walk through the trades that we made today in reaction to the action. Hit the tail of the tape and charts of interest. Let's get right into it. We'll start off with the S&P 500 here, and you can see, let's bring up a 5-minute chart. You can see the nice gap up and a cup forming in the first half hour, actually making a higher high, so it wasn't an immediate lower out of the gate. It looked like we were headed higher, but we did not. Made a higher high, immediate negative reversal, powerful negative reversal. So from 44.58 all the way down to 43.98 by noontime. 4,400, a reasonable spot to bounce. We did bounce, but only up to 44.14. Tested this level again, bounced again, but no, at this point this just looked, it turned into a giant bear flag, and at this point we're making lower highs and then continuing to make lower lows, and then a waterfall into the close from 4,400 down to close at the low of the day at 43.76. Major disappointment for the bulls. Intraday or early morning recapture of the 21, ran into the 50 and failed. Only one close above the 80 MA, so that makes that a shakeout, but bearish engulfing candle breaking back below 4,400. Next level down is that 7-layer burrito of support from 4,300 to 43.44. We'll see what happens should we get that low. But basically, there were some, I talked about bear flags, but they're not bear flags until they break. A lot of them broke today. No bueno is one way of summarizing the market. NASDAQ 100, so same situation, big gap up. Note that we did not form that cup. We started selling off on tech immediately. So that cup, nowhere to be found relative to what was going on in the S&P 500, and just a free fall off of the open. Uh, Same bounce after 12 o'clock that the S&P did, but then just lower highs and lower lows into the close. One close above the 21, that's basically a fake out now. Got above the 50, that's a fake out. Again, a bearish engulfing back below the 80 MA. Major disappointment for the bulls again. Let's go to the Dow. Dow gapped up into the 50-day moving average, failed there, back below the 8, and a bearish engulfing 4 candles in one. How about that? Down 1.1%. Failure back above that 34,600 level, which corresponded roughly with that 50-day moving average. Still holding 34,000, but now just 1.1% above the 200-day moving average. Let's grab those percent above the 200-day moving average on the other indexes also. We'll start with the S&P. That's still 5.7% above the 200-day moving average. The NASDAQ 100 is 13% above the 200-day moving average. So you can see the massive divergence in the strength of the big cap indexes. Let's go to mid caps. Uh, Bear flag above the 80 MA, not a complete bearish engulfing, but negative reversal nonetheless, closing at the lows. Hasn't broken below the low of last Friday, but not a good setup either, and it fits with the overall theme of the market. IWM small caps, bear flag failing at the 8, still at the 200-day moving average. So holding on by its fingernails. We'll see what happens here. Again, this is highly influenced by banks and oils. So this can outperform the market or underperform, really. Uh, it does go to the beat of its own drummer, but higher interest rates are not good for the market in general and for growth stocks in particular. Let's show the IWO, the poster child for small cap growth. Um, Negative reversal there also. Didn't make a higher high, interestingly. So that told us that small cap growth was weak even at the open. That was something that the fellows pointed out during our morning call, is that strength was not carrying over to the Dow and small cap. So the euphoria was centered on the big seven and AI and data center related names, and resulted in, as I said, an epic failure. Let's go to the VIX. VIX had a gap down below the 21 and reversed higher as expected with the market selling off. So we're back into a uh, negative look for the VIX, still below the 200-day moving average, but in keeping with what went on in the indexes. Indexes got above the S&P, got above the 21, failed. VIX got below the 21 and failed. So this is confirming the weakness in the indexes. Let's go to the dollar. Dollar was strong out of the gate today, making a higher high. This is again not good for stocks. Pulled back a little bit, but then it just worked its way higher as stocks were making their way lower. How did that impact gold and silver? Well, this was strong despite the strong dollar, but gave it back by the end of the day as gold closed flat. EDX uh, down 0.21%, basically an inside day. SLV down 0.8%, note an inside day after that big gap up yesterday. Bitcoin, EITO down 2%, still in this lower range that it's forming after the big gap down last Friday. Let's flip to bonds now. Higher rates have been a problem. Inside day today, after the gap up in prices, meaning the gap down in rates off of yearly highs. Let's go to TLT, the 30-year, the long bond. Big gap up yesterday, inside day today. Let's go to the TYX, the yield of the 30-year, lower low, and then back into the body, basically bouncing at the 21 day moving average. Let's see how this resolves after a big two candle move off of the all-time highs. Are we going to go or not all time, off of the recent highs and the yearly highs? Are we going to test those back? If they do, it's going to be bad for stocks. I'll show you the trade that we did to act as kind of a hedge when we get to the tail of the tape. So that's TYX, TNX, the 10-year after two candles off. A little bit of a bounce today. That is all the inter-asset correlation that we show. Let's go to the tail of the tape. You can pause this. So the stochastic positive crosses that we saw yesterday from oversold on the indexes and the RG8 all disappeared with today's action. We're certainly operating under the bear case with the move below the 21 and the failure there today. The news headline, as I mentioned, NVDA gap up turned sour. Tomorrow morning, Fed Chair Powell will give will give a speech at the Jackson Hole gathering of the of the economic elite. Happens once a year. Last year, his speech was very hawkish, and the market sold off big time before it. Let's see what happens this year. From a day count, rally attempt day 4 to rally attempt day 5. So I mentioned in last night's video, would IBD technically call a follow through day based on the action after hours? The fact that it spiked the NASDAQ 100 volume to get it to where it would have needed to be as with the price action. The answer was no, they didn't. But even if they would have, it would have been the odds of a successful rally would have been negated by the distribution today on the NASDAQ 100. So that ends that discussion right there, whether or not there was a follow through day yesterday, including the after hours action. So we'll just go with, we're still counting. We haven't broken the low of last Friday, so we're still counting in today is rally attempt day 5. With the false breakout, we'll just pump up the ADMA days below count to 17, 13 on the 21 day with the failed move above it. Yeah, we're short-term negative, positive here. Well, this didn't work, so let's at least get rid of that as that failed. We took a look at the intraday action. How about individual sectors? The only thing positive was banks today. KRE and those KRE, KBE, and those bounced after basically off of an oversold condition. So all 11 sectors negative. It was broad selling, not just limited to tech. They were down the worst though, XL, CK, and Y, along with semiconductors and retail too, as we're getting continued mixed bag of retail. So in-house, what we do? Well, after hours, after I finished the video last night, I added a little bit to NVDL, and then this morning, when it looked like we were bouncing, I added a little bit more to NVDL. But by the end of the day, those were gone. With the pullback in TBT, in other words, the pullback in rates to the 21, and the real estate we'll take a look at XLRE to explain why we went back into TBT and DRV. Basically, if these are going to continue to go higher, the market's going to continue to go lower. That's been the correlation recently. So this was the hedge we decided to put on, and it reduced our beta down to 0.82. Remember the target beta, as long as we're below the 50-day moving average. The target ceiling is 1.0. We approached that. In fact, got just a little bit above it with those NVDL buys, but we know a failure when we see one. We don't sell something the same day that we buy it very often. It happens maybe twice a year, but today was one of those 2 times. So the bottom line for the day, gap up on NVIDIA earnings report, negative reversal to an epic failure. S&P and NASDAQ fail at key moving averages as the bear flag is playing out in many, many charts. We'll take a look at what happened to those NVIDIA related sectors today and a couple that held up okay despite the negative reversal. So let's start off with what we bought today. TBT, uh, with the big move down. Remember, this moves up with interest rates moving up. So pull back to the 21, bounce here. Good risk reward if rates are going to return to the recent highs. So we put TBT on. We also put, let's look at XLRE. This is a move higher and a fail into a key moving average. We're very well aware that real estate does not thrive in a rising interest rate environment. We're also aware of the commercial real estate issues in banks due to people refusing to return to the office and a bunch of interest rate resets coming due on that. So this rallied up right into a failed level here. Basically, this was a bear flag that broke down. We rallied back into the same level at the 21. This is where we put the DRV, which moves opposite to XLRE. So you can see that pullback right to the 21 bounce there. Good risk reward for DRV. So NVIDIA, let's take a look at the NVIDIA chart. Uh, Opened, nicely higher, but that 500 level, we got up to 502.66. That 500 level, Livermore level, could not be overcome. We reversed there. Here's a 5-minute chart on it. And really, selling, this was the false rally attempt intraday. It was looking pretty good, got back up to 490. And this is where we put on that NVDL additional 1% buy. But again, the failure. By the end of the day, we got rid of both of those. The combined loss on those was like 0.15%. We don't like paper cuts, but we'll take them because the alternative is paper cuts can deteriorate into serious losses. So that's how that played out. So let's take a look at some other stocks that I pointed out yesterday were up as much or even more than NVIDIA. Let's start with semiconductors and a epic outside negative reversal here into the 50-day moving average, fail at that 500 level. That would have been a good short breaking below the 21 and the 500 also. Some other data center centric names that initially had gapped up and had great days. Supermicro got up near this 300 area. Here's the 5-minute on that. There's the big gap up, immediately sold. So from 300 to 257 in 2 hours. Ouch. It did at least bottom early and work sideways the rest of the day. But again, epic failure on SMCI. Also, a networking type stock, made a higher high, negative reversal, still holding the 21-day moving average. Look at the 5-minute on this. Same thing, gap up and then sold immediately into, and then closed at the lows of the day. This is institutions not participating and in fact exiting. So we'll see if this breaks below that 21-day moving average. It looks like it's bound to. One that held up a little bit better, VRT, but still down 2% on the day. Go to the 5-minute here, same situation, gap up, sold immediately. At least this one at least tried to bounce and then tried to bounce again late morning, early afternoon, but sold off into the close to close at the lows of the day. So those were the three that we were at least intrigued by from a data center hardware standpoint. As we gathered some details on NVIDIA's earnings report and the massive beat and raise. But, if the market's not participating, there's a reason why M is the most important letter in CanSlim. The second most important to me is the N, something new. And we've got that with NVIDIA, but new doesn't matter if the market is not working. SPLK. This one at least did work today with a gap up on its earnings report. Big volume too, up 13% on almost 6 times average volume. Good stuff there. From Splunk, held at least the pivot breakout from this base. We'll see if it can survive. Autodesk, another one that gapped up but closed near the lows of the day, basically giving it up completely. Snow was gapping after hours yesterday. The snow melted. The big negative reversal ended up down 5% on the day. And that's about it. So, bottom line, as I said on the day, is that caution certainly continues to be warranted, as this was just a epic failure in the market today for the bulls. The bears, they're probably saying "I told you so," but they were probably saying "I told you so" the whole way up while we were rallying. So that's just a blind squirrel finding a nut, um, as far as I'm concerned. And let's see, because so remember what we do here at Revere. We invest across leading time frames. We definitely want to be in leading stocks and leading sectors when the short term and medium term wind is at our back, but it's in our face right now. So we're focused on letting the S&P 500 decide uh, where it's going to base, stop going down as long as it continues to obey the 100 and the 150, and then especially the 200-day moving averages. It's just impossible to pick the turns on a daily basis with this. That's why we just keep um, that core piece in place. But the weaker sectors within the S&P, such as real estate, which is impacted by interest rates. Those are tactical shorts that we'll put on to shield the pullback on this. As I mentioned, semiconductors would have been a good one also on their failure into their key moving average. But it's not how much you make in the market; it's how much of that you can keep. So we're in keep mode. Now, after the negative reversal, we put a couple of positions on Uber. We're down about 2% on. uh, Minimal damage on those additional NVDA ads. And then we've got the NRGU, which we're down about 3% on a 1% position. And then TBT and DRV, we've got positive returns on those. Those are the hedges. And with that, I'm going to wrap up today's video for Thursday, 8/24. This is Don Vandenbord with Revere Asset Management with the tough love on the market today, telling you what you need to hear, not necessarily what you want to hear, but it's the facts, just the facts here at Revere. Thanks for listening and have a great day.